Good afternoon and welcome to today's webinar with Temple Melville from ScottCoin, who's given to give an introduction to cryptocurrencies and blockchain. It's a fascinating alternative asset and one that I'm sure we're all looking to learn a lot more about in this presentation. I'm going to put up a poll on the screen to understand how many of today's audience have bought any cryptocurrencies recently. So I'm just going to put that up on the screen. Hopefully you can all see that. If you could just complete that poll, that would be good. It would be useful to know who's what we're looking at. Okay, interesting stuff. Feels like about 80% of people haven't bought any blockchain or cryptocurrencies before. So this is an asset class that the majority of our audience haven't invested in yet. Before I hand over to Temple to start his presentation, I just wanted to run through a few admin points. You're currently on listen only mode. If you do want to ask a question, please type that into the Q&A box at the bottom of your screen. We've had a few questions come in ahead of time and we'll cover all questions at the end of the presentation. The format for today is a presentation from Temple. It's going to last 20-30 minutes and then we'll have 15-20 minutes for Q&A at the end. I'd now like to hand over to Temple to start today's presentation.
Good afternoon. Thank you very much for that very nice introduction there. That's a pleasure to be with you all this afternoon. Just a little bit of background about me and why I'm even involved in this. I was interested, first of all, in blockchain a very long time ago, because what we call blockchain actually came out of the Linux Foundation's work in the sort of 90s and noughties. And the reason was that they were working on different subjects and different projects, and they needed to know exactly where everybody who was involved in the project was with their work. And the problem was that they had lots of people, mostly spoke English, but not all of them. But they could all speak code, and as a result of that, they set up a system whereby everybody that was working on a particular problem got all the updates and all the information at the same time, so that they all knew exactly where everybody was. Now, that is actually the basis of what blockchain is. It is telling everyone on the system, all at the same time, exactly where everything is. And if you bear that in mind, blockchain becomes much simpler to understand. Blockchain came out of the 2008 disaster as far as the banks and all the rest of it were concerned. And in many ways, we're in a similar situation at the moment, with billions and trillions being printed, and dollars and euros and pounds and all the rest of it. And the feeling was amongst a lot of tech people that it would be really good to have a system whereby the banks were cut out of the system. And if you think about it, what we have is, if you give someone your credit card to pay for something, there is at least one, and usually several, people in between you and the person who gets the money. And as a result of that, every person who takes it has a little bit of what they call a clip, and they get a few pence for what they're doing. However, the blockchain people and Satoshi Nakamoto decided that what they really wanted to do was to have a situation whereby it was what's called peer-to-peer. In other words, there wasn't a middleman. There was just, you know, for example, if I want to give Alex some money, I just simply send him the money, and the money goes direct to him with nobody in the middle. And that is a really important thing for people, particularly at the moment. Now, let me start by explaining the most important thing. And if you grasp this particular concept, you probably know more than 95% of all people who know anything about blockchain and Bitcoin. You can see it up on the screen there. What is the relationship between blockchain and Bitcoin? Blockchain technology could exist without Bitcoin. Blockchain can do lots and lots of things, and I'll talk about that later. But Bitcoin could not exist without its blockchain. So blockchain is an enabling technology, but Bitcoin is only one expression or iteration of the use of blockchain technology. And there are all sorts of different uses of blockchain and so on, but as I say, I'll come on to those later. So what is blockchain? Blockchain is a method of recording data. It's a digital ledger of transactions, agreements, contracts, anything that needs to be independently recorded and verified as having happened. The important thing to remember is there is no such thing as a Bitcoin. I'm talking particularly about Bitcoin, but it applies to all crypto transactions, really. There is no such thing as a Bitcoin. There is simply a string of code, which in the same way that your bank account when you go online is just a string of code, but it transforms itself into telling you you've got £5 or whatever it is in your bank account. It's exactly the same with Bitcoin. It's a string of code, and that code translates into the fact of you having some Bitcoin in your wallet. The result of that is that you have, when I send money to Alex or somebody, the deduction is made from my wallet, it gets sent directly to Alex's wallet, and there is code at both ends that records that transaction. Now, the extremely clever thing about blockchain is that there are effectively, and this is an oversimplification, but it's a valid transactional idea. There are two bits to each transaction. The first bit is what I would describe as the transfer of money. So the first bit is the £5 going from me to Alex. But each transaction has a secondary part, which is what I refer to as notes. Now, you can put absolutely anything into those notes, and this is the basis, in fact, of smart contracts, which again I'll come on to talk a little bit about later. You can put anything you like in those notes, and in fact there's some poor child who some years ago had all its birth details put onto a transaction in Bitcoin, and the net result, of course, is that that will be there forever, and she can never pretend she's a different age because somebody can look it up and there she is. But it's a very useful thing to be able to record something which is date stamped, has been verified, and is absolutely immutable. Immutable simply means it can't be changed, and I'll go on to explain why it can't be changed in a minute. So here we have what is the various ways of using various systems to record things. So if you look at the top left, you'll see a centralized system. And you can very easily see that there is one point of failure there. And basically speaking, that is what banks and most systems have. They have one point that can be attacked. We're always hearing about hacks of various people, Twitter and everybody else you can think of, because they have a single point of contact. Now, if we move along a little bit, we go to a distributed ledger. Now, distributed just means that not all the information is held in one place or one central place. It's held in 2 or 3 different places, and it can then be recalled from those various places and put back together again and so on. And that's obviously better. There's more places to attack if you're a hacker. Decentralized is even better, because what that means is that every piece of information is held by everyone in the system. Now, the great thing about that is that if everybody has a set of the data, if you want to change it or you want to do something to make it different, you actually have to get everybody to agree to do that. And that is why blockchain and Bitcoin and other alt currencies are so strong, because all the information about what has happened and what is happening is broadcast to all the people who are involved in it. The people who are involved are called nodes. Nodes just means computers. They're also called miners. Miners just means computers. But basically speaking, it means that everybody who is on that system gets all the information at the same time, and it can therefore be checked against it. And then down at the bottom, you see peer-to-peer, and that was what we were talking about, that the information or the money or whatever it might be passes directly from one person to another, and there is no intermediary person at all involved in it. So what is distributed consensus? In traditional models, we require a trusted third party to execute transactions on our behalf. This goes back to what I was talking about with a bank in the middle or a credit card company in the middle. We need to have a third party to actually execute the transactions. I, spending the money, trust that the third party will send it to the person with whom I've paid, to whom I've paid. The person to whom I'm paying trusts the bank to give them the money. And in fact, banks spend billions and billions every year trying to make sure that they maintain the trust of the people who are in their system, because if that trust went, they wouldn't have anything to sell, really. So consensus provided by blockchain does away with the necessity for a third-party guarantor. And that goes back to what I was saying, that it is peer-to-peer. There isn't a third party in the middle. Everybody who is on the system has the information that is what's transpired, and so it makes life very simple. And what that really means is that the blockchain itself is the guarantee, and everyone on the network has access to the ledger, so it's completely transparent. That is a big, big basis. But how exactly does it work? So the first thing to think about is, and it's fairly obvious, it's called a blockchain. So there are blocks, and each block has a certain amount of data in it. Now that data is sent by the people who are doing transactions and so on. And each block has, it lasts for about 10 minutes and it has a megabyte of data in it. And when that block is full, that block is shut and no more information can be put in. Now, the blocks themselves are bound together in a string, which is using very, very strong cryptography, lots of mathematics and lots of stuff that's really far too difficult to understand, but it all works. And the people who do that are people called miners, although they're, as I said, it's really computers, and they compete to validate every transaction within a block. It's a very complicated situation because they have to use the computers to run through various transactions and various computations. And validation is effected by solving complex mathematical puzzles. And this is what we call proof of work. There's other forms of proof, but this one is proof of work. And what that does is it says, right, this has now been solved, and the first miner to solve the maths puzzle earns a certain amount of Bitcoin. This incentivizes the miners and ensures they're always willing validators. Now, there's an important point here, which is actually one of the questions that was asked covers. At the moment, each block earns the first miner to solve the maths puzzle 6.25 Bitcoin. Now, it started out, when it did about 10, 12 years ago, it started out as being 50 Bitcoin per block. That then halved to 25 after about 4 years. It then halved again to 12.5, and in fact, it went down from the 12.5 to what it is at the moment, which is 6.25, just in May last year. And it halves roughly every 4 years. Now, what that actually means is that there will still be Bitcoin being mined in 2140, which is a long way away and won't bother anyone here today, that's for sure. But the point is there is going to be money to be made irrespective of the cost of a transaction by the people solving these equations. And there is a big incentive to then think in terms of, well, if it's going to be less and less, surely it must become worth more. Who knows? It's certainly what has happened in the past. So to complete each block, a majority of all miners must agree that the solution is correct and the data input is valid. Now, what that means is that the first miner solves it, he then transmits that information to all the people on the network, and they all go, oh yes, that's the right one, bing, that's the end of it. Now, what that means is that block is then closed completely. Now, the clever bit is the next bit. So here we have the first block, which is block 99. And you can see there it says previous hash. Now, what a hash is a little tiny piece of data that is compressed. Think about a window box. You have a window box with soil in it, and there's nothing in it, there's nothing happening. And then somebody comes along and puts a seed in it. Now, that is like the hash that goes into a block. And it gives all the information on all the previous blocks. So it's a lot of data, but it's all there. It can be handled quite easily. And that starts off block 99, as we have here. The miner or the node that's operating enters his key. There's a timestamp. The various transactions that are detailed get put into it. And you see there's 3 transactions showing there. So at the end of that 10 minutes, the block is full and a new hash is created, again, taking all the information from block 99 and everything before 99. So it's got 99 blocks of data, which then get moved over to block 100. And the process starts all over again. So it just continues on each block going forward. Now, there's an important point here that people are always saying about, well, can it be hacked and so on? Well, yeah, I suppose it could be hacked, but you have to think about it. You can't change what's in the previous block. So if you were going to actually hack it, you'd have to somehow change all the blocks that have transpired right back to block 1. There's now something like 600,000 blocks, which is a lot of data, and you'd have to change them all to be able to hack the whole system. So I'm going to talk about a little bit more about that later, but that's just a thought to keep in mind. So within each block is linked to the block behind it by that block's hash, which I've explained. And once updated, the ledger cannot be altered or tampered with. New blocks are broadcast to everyone in the network at the same time. This is the important point. Everything is broadcast to everyone at the same time. And this is just another representation of how it works. New transactions are broadcast to all nodes. Each node collects new transactions into a block. Each node works on finding a difficult proof of work for its own block. When a node finds a proof of work, it broadcasts the block to all nodes. Nodes accept the block only if all transactions in it are valid and not already spent. And nodes express their acceptance of the block by working on creating the next block in the chain using the hash of the accepted block as the previous hash. And you can see all the little bits of data that come into it, and it makes it very secure. Now, I'm actually going to diverge a little bit at this point and say there is something very important here, which is what are called when you have a transaction that is a smart contract. Now, the smart contract goes back to what I was saying about the first bit is information for the actual transaction, for the monetary transaction, and the second part, the note, has information in it. Now, what that means is that you can use those notes to be, if such and such happens, then such and such can happen. It's a bit like an escrow situation. And that is very useful for all sorts of reasons. I was speaking not that long ago to people who operate supply chains, and of course it's very important from their point of view to be able to be absolutely certain of where something has come from, and of course to get paid or to pay out for it when it arrives. And the blockchain can actually do all that and guarantee all that without any problem whatsoever. The other thing I want to talk about briefly is blockchain a Ponzi? Because people are always talking about Ponzi's and so on. And I have to tell you, blockchain is not a Ponzi. There are various attributes that happen with Ponzi's. Basically speaking, you have to get new clients in all the time to enable them to pay out the people who have invested previously. There is no such system. They usually promote high and unusual returns. I know people are busy trying to promote Bitcoin by saying they're making huge returns, but there's no guarantees. They don't make any interest payments. It is in fact perfectly secure. Nobody's asking you to buy them. You can buy it if you want. You don't have to recruit anyone. There's all sorts of different aspects that are not Ponzi-like. And there's a very nice situation that you can look at. You can use it as a litmus test. Does it promise regular returns that exceed average market returns? It's probably a Ponzi. Does it focus more on recruiting new people than on a product? It's a pyramid scheme. And there are situations where pyramid schemes are okay, but in general terms, I tend to say they're not that wonderful. So I think that's probably all I need to say at the moment. I'm going to just go over and say any questions, because we're very happy to answer anything that anybody wants to know.
Brilliant. Well, thank you, Temple, for that introduction to blockchain cryptocurrencies. As you say, we're happy to take questions now. Just as a reminder, there's a Q&A box at the bottom of your screen. If you've got any questions to ask, please type it into the box at the bottom of the screen, and we'll come to those questions. We've had a number of questions come in ahead of time, and I'm going to start with some of those now. So the first one is this. So once Bitcoin is fully substantially mined, will transaction fees be competitive whilst also providing miners, blockchain maintainers sufficient fee income in place of the current mining rewards to retain their commitment to the blockchain management?
Well, the first part of the answer to that question is that, as I said earlier on, because of the halving system, there will still be Bitcoin being paid out for completing blocks right up to 2140. So it's quite a long way out. But the other thing is that, in fact, the price of transaction fees goes up and down quite a lot. I mean, I've seen recently, you may or may not know, but Bitcoin has been rising quite substantially over the last few weeks. And as a result of that, the transaction fees have risen quite a bit. And the length of time you have to wait to get a transaction completed has lengthened and so on as well. So at the moment, or in the last 3-4 weeks, I've seen a transaction fee as high as $150. Now, $150 is fine if you're doing £1 million transaction. It's not much cop if you're trying to buy a cup of coffee. And the normal standard rate, I would say, is probably between 50 cents and $2 is the normal transaction fees. But they can go up dramatically when the requirement is for more transactions to be completed. So although there will still be, for the next 120 years, there'll still be Bitcoin to be earned, people will need to, or miners will need to have more income from transactions. But I think that will be a natural consequence. It'll, as time goes by and the values go up and so on, I think people will be perfectly prepared to pay more for a transaction.
Okay. Here's another question for you. How do you avoid losing records of your transactions without compromising your security?
Um, well, the real point is that you have a thing called a wallet, and a wallet contains your Bitcoin or whatever else it might be. But the point is that the blockchain actually records all the data in respect of your transactions and everybody else's transactions. And you have what's called a web explorer, and the web explorer checks the transactions actually on the blockchain. And that means that at any given time, you can look up and type in your wallet address into a blockchain explorer, and you can check all the details of what has transpired, both ins and outs, for that wallet. It's a very simple system, and it operates on all cryptocurrencies, so it's a very good system.
Okay. Another question here. If in the altcoin space, where can information be accessed that would permit some evaluation of the relative merits, prospects of different coins like Ethereum, Bitcoin, Scotcoin, etc.?
Well, there's two big areas. The first is, in fact, CoinMarketCap, coinmarketcap.com. They have lots of data about all the different altcoins and Bitcoin and Ethereum and so on. And also another one called CoinGecko, which again has lots of information. But you can just type in, for example, if you want to see what Bitcoin's doing in terms of the number of transactions or the number of the amount of money it's being traded or anything like that, you can just type that into Google and it'll come up. There's lots of information out there. There's charts, there's everything you can think of. I have to tell you that as far as I'm concerned, I don't think anybody really knows which way Bitcoin's going or anything else is going at any given time. It's one of these things that you just can't fathom really, but in the long term, it's bound to become more valuable.
Okay. If the price of Bitcoin collapsed to allow mining to be profitable, the difficulty level will fall. Is there a level of difficulty where security is compromised?
The short answer to that is no. Just to give you a little bit of information about the security, I go back to what I said, that everybody has all the information, instantaneously. Now, the way I like to do it is to say, people are always talking about, oh, it's like trying to find a grain of sand in the Sahara. Well, let's take that up a bit and let's go and say, well, it's got to be like a grain of sand in the whole world. And I was actually face to face with some people some time ago doing a similar talk. And I said to them, do you think that's secure enough? And everybody said, oh, no, that's not enough. I said, okay, well, let's just go to a grain of sand in the solar system. And about half of them thought that was probably okay. And then I said, all right, well, let's just take that another step further and say all the molecules, all the grains of sand, everything in the entire universe. Do you think that's probably enough? And of course, everybody agreed that was probably safe enough. And what that really means is that that's the very least. And in fact, it's probably too difficult to actually calculate all the different permutations and possibilities. But the point it's being made is it is incredibly secure and very, very difficult to hack. People are always talking about being hacked. You have heard, I'm sure, about lots of people, lots of exchanges being hacked, but you'll never hear about a blockchain being hacked. The exchanges have the single point of failure that I was talking about earlier, whereas the blockchain itself has so many points of contact and so on that it is impossible basically to make that hacking attempt.
Okay, thank you. Another question here. Will the Bitcoin blockchain be solely used for very large transactions to avoid being clogged up with low value, high volume transactions?
The answer to that is no, I don't think so. There is a new thing which has been trialed and it's now actually available. It's called the Lightning Network. And basically what the Lightning Network does is say, Mr. A and Mr. B transact between themselves half a dozen times a week in fairly low quantities, but we don't need to put that actually on the blockchain itself. We can do what they call a side chain. And the side chain, all it does is it just takes all the various transactions between Mr. A and Mr. B and nets them off. And at the end of the week or the month or the whatever it is, they then say, okay, we'll do that on the main net, what they call the main network, blockchain network, and that gets put through. And that does several things. The first thing it does, of course, is save on transaction fees, because if you're doing 10 or 12 transactions just as one transaction, then you obviously saved yourself half a dozen transaction fees. But the other thing it does as well is it takes away lots of smaller transactions. And certainly there's something like, I think, 3 million people are now using the Lightning Network. So that's a lot of small transactions taken away.
Okay, thank you. We've got a couple of questions here on tax. First one is there any clarity on the UK tax situation for crypto? And the second one is the tax system going to need to be completely restructured to deal with the movement of assets and transactions using decentralized crypto?
I think the best way to answer this is to say that basically any profit, whether it's from interest or from capital gains or anything else, is taxable in exactly the same way. I'm talking particularly about the UK, but it's pretty much the same everywhere. So in other words, if you buy, a Bitcoin for £300 and you sell it for £10,000, you will have to pay tax on that. And in fact, it's basically speaking, HMRC said that quite some years ago. They basically said anything, any way you operate, it's exactly the same as any other financial transaction. And what that also means is that the change in laws and so on to encompass the situation with blockchain and Bitcoin and so on, there probably won't need to be any, because it's basically set in stone that it's part of the profit and loss situation as far as HMRC is concerned. And the other thing that's happened, which is making things better, is that there is legislation is coming forward, there is regulation which is coming forward and is already in place in some cases, which makes a huge difference. Basically speaking, if you go on to an exchange to trade, you have to be KYC and AML checked. The only way you can avoid that is by dealing with someone, again, peer-to-peer. But as soon as you want to take it for cash, you've then got to go through an exchange, and therefore you're involved in the tax system at that point. So I think it's unlikely that there'll be any necessity for a change in the laws and so on to encompass, particularly the tax laws in respect to blockchain and Bitcoin and so on.
Okay, thank you. Another question here. What is your opinion on protocol of stake as opposed to protocol of work, which I think you talked about?
Yes, proof of work and proof of stake. The problem with proof of work is that it is very expensive and very resource using. I mean, I think Bitcoin now is supposed to be using as much electricity as Switzerland and Austria put together every day, which is an awful lot and very wasteful and not good for the planet and all the rest of it. So there is a sort of move, and there has been a move to move away from proof of work to proof of stake. And for example, Ethereum, which is the second biggest cryptocurrency, has nailed its colors to the mast and says we are moving from proof of stake to from proof of work to proof of stake. That hasn't happened yet, but it will probably happen in the not too distant future. The proof of stake, it works very well because the requirement is basically that the people who are staking whatever the currency is to be able to do it get voted for by their peers. So in other words, if you don't operate in a proper manner, your peers will vote you out and say, no, you can't anymore do the staking and so on. So proof of stake is a very good system, and in general it works very well. There's various people have started their entire system by using proof of stake, and it's proven itself to be very good. So I'm particularly, we've just moved from Bitcoin blockchain to the Ethereum blockchain, and one of the reasons was because we believed that Ethereum would be moving to proof of stake.
Okay, thank you. What impact would the introduction of a centralized digital US dollar have upon Bitcoin and alternatives?
I think the answer to that is that there is a basic difference between a government stroke, treasury stroke, whatever you want to call it, promulgated coin and Bitcoin. And Bitcoin, as I said, grew out of the 2008 disasters, whereby people didn't want banks to be involved in what they were doing and so on. Now, if you say, okay, you know, the US Treasury or the Fed or whatever is going to do a digital dollar, I mean, there are very good reasons for doing it. Apart from anything else, the cost of transactions for large sums drop dramatically. And one of my favorite things is that the Philippines are in fact talking about only allowing or only having a system whereby all the Filipinos around the world send their wages back to the Philippines using Bitcoin, because that would save the Philippine economy something like $1.5 billion a year. And that's, you know, that's quite a bit of change and so on. It's good. So I think there would be reasons for using a US dollar, you know, cryptocurrency. I think there would be a lot of people who would not use it. And the other thing that would be relevant would be, would it in fact be anything other than just a sort of another US dollar? And in fact, this is one of the big questions of the day. We've had all this gigantic sums of money printed and so on over the COVID situation. You know, I was talking to somebody the other day. There's something like $15 trillion. It's not only dollars, it's pounds and everywhere else as well. There's something like $15 trillion out there at the moment. They've just announced they're going to print another, I think it's 3 trillion or something. So if you've got $1, you had $1 in 15 trillion this morning, and next week you're going to have $1 in 18 trillion. If you've got Bitcoin, you're only ever going to have 1 in 21 million Bitcoin. And that has a profound effect on inflation. It has a profound effect on value. It has a profound effect on security and all sorts of things. And one of the great things about Bitcoin and cryptocurrency and so on is that they have become an asset class. They're another asset class like stocks and shares, like gold, like whatever you want to call it, whiskey and so on. I took part in a program the other day where somebody was arguing that storing whiskey away was perhaps the best hedge of inflation ever because you can always drink it. And that's true as well. But the point is that it is an asset class. It only represents about 1% of the assets, 1.5% of the world's assets at the moment. But that argues that you should have 1 or 1.5% in altcoins or in Bitcoin or whatever. So I'm very bullish on keeping something back to try and mitigate this what I believe is going to be a very big inflationary effect.
Okay. Other questions come in here. What risk is there to cryptocurrencies from government's determination to control money supply, tax avoidance, and what's the risk from supporting illegal activities, you know, drugs, terrorism, etc.? You know, the government might want to try and curtail these alternative currencies.
Well, famously, Bitcoin was always supposed to be, you know, involved in the dark web and this and that and the next thing. But in reality, and despite the fact of what people say, actually the biggest holder of Bitcoin at the moment is the US Treasury, because they bust the cartels and so on, and they seized their assets, which included all the Bitcoin. And there is now, as I said, if you want to use any cryptocurrency, you've pretty well got to be on an exchange, and the exchange, you've got to be KYC and AML checked. For example, the FCA in the UK, we're just in the middle of being registered with the FCA. It's a very long-winded and a very searching process, and it's unlikely that they would be seeking to regulate it if they were just going to ban it or to take it away or whatever. One of the points about cryptocurrency is that it is mildly deflationary as opposed to inflationary, which all other currencies are. The reason for that is that in general, either it's a fixed amount that comes out in the first day, as it were, and that doesn't change, and that of course is deflationary because everything else goes up. And the second point about that is that for example, Bitcoin at the moment is with this 6.25 Bitcoin per block. That actually represents something like a 1% inflation of the amount of Bitcoin that's out there at the moment. Now, you can argue that everything's very low in terms of inflation and so on, but that is actually less inflationary than the amount of gold that's being dug up at the moment. Gold is, for the last few years, has had an extra 2.5% or so added to its stock. And that, of course, means that gold is being inflated effectively. So there's a lot of good reasons to be less worried about things than seems to be suggested by the question.
Thank you for that, Temple. I know that you're involved in something called Scotcoin, which is a version or variety of cryptocurrency. I wondered if you could tell us a little bit about Scotcoin and how you could access that if you wanted to. Talk us through that a little bit.
Right. Well, I'll give you a sort of potted history. Scotcoin was created about 2013, so we're actually one of the longest lived of what's called the country coins. You've probably heard maybe of Aurora coin or Catalan coin or Irish coin and so on. Well, we're one of those people, and the present management got involved late 2015, early 2016, and we've been working very hard to get to the stage where we are actually just arrived at now, which is that we have our new ERC20 token, which is on the Ethereum mainnet. The reason for that is that ERC20 tokens are pretty much acceptable anywhere, and we will be going on to an exchange next year to enable everyone to trade as they wish. At the moment, we sell Scotcoin through our own exchange, and there's always, off-market deals to be done. But in essence, we are looking to expand the number of people who have wallets of Scotcoin and enable them to be used. And there's a variety of different ways it could be done. We've just done a project with, in fact, the Scottish Professional Football Leagues that we offered everyone who has a season ticket holder. As you probably know, if you're interested in football, things are pretty grim. And the clubs, particularly in Scotland, need to get their people to buy season tickets. And if they get, if they're paying, say, £200 or £300 for a season ticket, we've offered them £100 back in Scotcoin, which is a good step in the right direction for them. So we're particularly involved, in fact, with what I would describe as the charity eco sector. We're very keen to make things better for the disadvantaged of society. We have contacts with various charities in Scotland and beyond, with the IPPR and so on. And now that we have our new coin, which literally is only in the last couple of weeks that it's been fully operational, we're ready to move forward on that one.
Fantastic. Thanks for telling us about that. We've got time for one last question, which has just come in. I don't completely understand it, so hopefully it makes more sense to yourself. And the question is, if fiat currencies, I'm not sure what a fiat currency is, if that's
that's pounds, dollars, euros, etc.
Wonderful. Now you know what it is. So if fiat currencies convert to cryptocurrency, they will prevent fractional reserve banking. Isn't that a major danger to world economies?
I think there's perhaps a slight misconception there. I think what would appear to me, I've never thought that there is only going to be either fiat currencies or cryptocurrencies. I think the two will sit side by side. One of the more interesting things about cryptocurrency, in fact, the original, well, anything could be a cryptocurrency. One of the original modern day, for lack of a better expression, cryptocurrencies is a thing which has been operating in Switzerland since the 1930s, and that is called VIR, W-I-R. You could look it up on the internet. It's a very interesting subject. Basically, what VIR did was in the 1930s, nobody had any money at all, and various people got together in Switzerland and said, we still require to trade. We will trust each other to trade using a cryptocurrency. And it's, they said it's 1 VIR is worth 1 franc. And that has progressed until now. So this is 80, 90 years later. VIR in Switzerland has about 70,000 businesses that accept it. It has about 600,000 or 700,000 people that use it. It transacts something like about 4 or 5 billion Swiss francs a year. And the great thing is you don't have to, you could go into a shop and say, I want a sofa, I want that sofa there. And the man says, that's 1,000 Swiss francs. And you say, well, I haven't got 1,000 Swiss francs, I've got 700, but I've got 300 VIR. And the man in the shop will say, oh, that's absolutely fine. Here you are, take it away. And he will then use those VIR to go to somewhere else, maybe one of his suppliers or whatever, and exchange his VIR for a product, another product. And that is pretty much how I see cryptocurrencies working in the future. There'll always be a place for fiat currency for sure. But I think it'll be, alongside cryptocurrency as time goes by.
Temple, thank you very much for that. And thank you very much for explaining cryptos for us today. I know you've written a book on cryptocurrencies. It's an ebook. And if anyone wants a copy, a free copy, I might add, all they need to do is just email info@yellowstoneadvisory.com and we will send you a copy. Before we go, I just want to mention we have another webinar this week, and that's with Diversified Gas and Oil. That's tomorrow at 1 o'clock. If you want to register, please just go to www.yellowstoneadvisory.com. And I don't think there's anything else to say except to say thank you, Temple, for presenting, and thank you for everyone for attending. And we hope to see you soon. Thank you very much.
My pleasure.